Welcome back to the show, ladies and gentlemen. I'm your host, Terry Julian, and in today's episode, I'd like to talk to you about the proper ways to purchase call options. Now, call options are very popular investment vehicles that provide significant returns for traders who are looking to use leverage. We will be discussing the right options to purchase when we have come to the conclusion that there's more buying pressure than there is selling pressure. We purchase call options. Now, what and how do we purchase these call options is what we're going to discuss today. So sit back, relax, grab a pen, grab a piece of paper, and I'm going to teach you how to select the best call options for your trading. So, first and foremost, let's discuss why out of the money options are great ways to lose money and why so many traders buy out of the money options. And the problem with that is that many traders look at, you know, their option selection with how much money do I have and how can I use what little money I do have to make as much as possible instead of thinking about how do I limit my risk? How do I make sure what option I do select, I get in profit as soon as possible? So let's go and look here on this option chain that I have for Apple. I took this from from Yahoo Finance. As you can see here, it has our ticker AAPL, which is Apple. The year, this is 2023. 04, which represents the fourth month of the year, which is April. And 21, which is the date of expiration. So this is the Apple 2023 April 21. So April 21st option chain, call option chain that you are looking at right now. The shaded area is in the money. Out or non-shaded or white area is your out of the money options. Now again, going back to how most traders pick their options is they look at the price and say, the price is going up, right? We believe that buying pressure is exceeding selling pressure. All of our options, all of our moving averages say that the prices are going up and we're going into bullish momentum, or it is bullish momentum. Oh, wow, look at this. $199 for $170 strike, $200. This is all I have to spend to get this option. If stock continues to go up, I can make a huge return on this strike price. Now, I'm going to show you why that's a horrible thing to do. Now, let's move on. We've decided to go and move forward like every other trader does. $170 call option. We're going to take that for $1.99. He thinks he's making a great deal on this, and we're about to show you why that's a horrible deal. So let's first figure out what's our break-even price. Please pause and rewatch this video anytime you need some more understanding if I'm moving too fast. We've got to find our break-even, right? $170 is our strike price plus the cost of the option, which is $1.99. So our break even is $171.99. That is our break even. So now let's find our distance to break even. So our distance to intrinsic value, which is basically when this option would go in the money. So how far is that from the 171.99? We need to find that by percentage, and we need to find that by numerical dollar form. So we'll take our break even, subtract it from our current stock price to find that dollar value. So we'll take $171.99, which is our break even that we discussed on the previous page. We'll subtract that from the cost of Apple stock right now, which is $153.85. So we now know that Apple has to travel another $18.14 in order for us to break even. Now let's find the percentage of that. $171.99 minus $153.85. We get that $18.14. Divide that by the current cost of Apple stock, which is again $153.85. We should get a decimal form once we get to that point. We want to get it out of decimal and show a percentage. We'll multiply that by 100 and we get a percent of 11.79%. So with this being February 14th, 2013, or February technically 13th, I just moved into midnight here. Folks, you're going to need Apple to move 5.9% this month and next month in order for you to break even at expiration. So you're going to need Apple to not lose money for 2 months straight from the moment you purchase this stock. It doesn't mean, it can't go down, because stocks do go down, but you need it to eventually go higher and end positively, right? Over 5.9% for the month, each month until expiration. That is very, very low probability. And we're going to talk about why. That's a very low probability, because if you look at the Apple historical data for the last year, you'll see that you can quickly come to the conclusion that you would have had a losing trade every single month if you would have bought an out of the money option, $20, $30, $40 out of the money, because there was not a consistent 2 months where Apple was in the green. Only recently, January of 2023 and February of 2023, where you have Apple showing 2 months straight in the green, well over 17% so far. But you would have lost money every single month last year if you would have taken a $30, a $40 out of the money, option on Apple. You would have lost your ass. And that is why buying out of the money options is such low probability. It's not a great way to invest your money. Now, what have we learned? Out of the money options can produce big returns if the underlying stock makes substantial price move in the right direction before expiration. Most of the time, however, stocks do not make that expected large move by option expiration, and the out of the money option that you bought expires worthless. All that time value that we find has now gone in the hands of that call seller. You've lost money. And with that type of strategy, buying out of the money options, you put yourself at risk for total loss of your trading capital. This is not an acceptable risk if you want to stay in the game, if you want to be a long-term option trader. Now, let's show you the better way to trade. The in-the-money difference. As I mentioned earlier, we are looking at the Apple call option chain. The blue shaded area is the in-the-money options. Now, as you can see today, February 13th, Apple gained in value, and Yahoo has nicely generated the percentage gains for each option in the money. Now, as you can see here, these are not being shown, but that doesn't mean they didn't go up in value. In fact, go ahead and press pause, pull out the broker you use, whether it be Robinhood or whatever it is, you'll be able to notice that yes, these options on this particular day did gain in value significantly. Now, which option would I want to select? I want to select the furthest I can go that actually makes sense for me. And in looking on this chart, how far is that? I'm looking straight at this $110 call, ladies and gentlemen, for $45.95. Whoa, you're saying. I know what you're saying. $45.95. Whoa, that's an expensive option. But ladies and gentlemen, I'm going to teach you how to buy these options at affordable prices. But for right now, I want to just explain why purchasing that option makes sense. Let's find intrinsic value for this in the money option. Now, we didn't have to find intrinsic value for out of the money because out of the money options do not have intrinsic value. They are out of the money. They have no value besides time value. That's why they're so risky. So let's find intrinsic value for this in the money option. So we know that again, Apple's trading at $153.85. We like the $110 calls going for $45.95. Current stock price, $153.85 minus $110. That is $43.85 of intrinsic value. That is, if I bought the $110 call and I went ahead and exercised it, right now at this moment, I'd have over $43.85 of intrinsic value built into that option. So it's a profitable option. Now, let's find what the time value is, because again, in the money options, we get that intrinsic value, but we don't get time value, right? Because it's got intrinsic value. So we don't get time value. You got to find what time value is. So we take the option price, which is $45.95, subtract it from the intrinsic value that we got, which is $43.85, and we found the time value. We found the time value. So that means we only have to go 2 points for us to break even on this option trade. Now, what is the percentage of that? We take $2.10, right? Divide that by the price of the stock. So 210 divided by 153.85. We should get a decimal, and then we're going to multiply that by 100, and we're going to find 1.36. So with this in the money option, we only have to go 1.36% in order to break even. When they say people with money just make more money, this is why, folks. If you save more money, if you know how to play the game, and you buy these deep out of the money options, particularly again when buying pressure is exceeding selling pressure, we know the stock is going up. We buy deep in the money options because we want a high probability chance that we're going to make money on our option. And if the market is bullish, Apple is bullish, is there a high probability chance that we are going to go up 1.36%? Yes. So this is a high probability way to trade. So we want to buy deep in the money options, right? Deep in the money options. So let me go ahead and correct this right now. I actually should have corrected this earlier. Hold on here, folks. Let's go ahead and correct it now. This is supposed to be 210 because I'm not doing this again. Right? And 1.36. So Apple would only have to increase 2 points, 2.10 points, or 1.36% for you to break even. I got to say that again. Only 2.10 points or 1.36% in order for you to break even. So buying in the money options has a higher probability of being profitable. So in the money, going up 2 points of 1.3%, 1.3%, 36% within 2 months. Out of the money, which we showed earlier, you've got to go $18 or 11.79% within 2 months to break even. Which one would you rather take? Yeah, I'd rather commit more capital and buy that deep in the money option because my probability of being successful is so much higher. So much higher. So I've made a few assumptions here. One, that you've got capital to spend. Two, you enjoy buying one leg options. And three, you're excited about these one leg options because you're excited about unlimited upside potential if you're going long or buying long calls. But what if you don't have that kind of money? Sal, I don't have $4,500. Where I'm going to show you in my next video how to get into these trades with less than $1,000. Now, here's the downside. When you're using options that get you into these deep in the money option contracts, but you don't have the ability to play them with one leg. Well, they limit your downside risk, but they also limit your upside potential. So you'll be able to get the same probabilities of success, but you will have to deal with the fact that your upside potential is limited. And that's fine, because the magic of compound gain says if I continue to be successful doing the right thing, making those gains, eventually I can be able to take the kind of trades that put me in the green by buying one leg and being able to enjoy unlimited upside earning potential using one leg. So, ladies and gentlemen, if you've enjoyed yourself, please like this video, press subscribe, share this with your friends and family who are looking to learn how to trade. Why buying in the money options is the best way to go. In my next presentation, I'm going to show you how to do these with puts. Out of the money puts, in the money puts, finding the best put options, low cost entries, and so much more. So I've gotten the out of the money out of the way on the call side, in the money out of the way on the call side. Next one is the put options. Out of the money, put options, in the money, and finding the best way to play those. Right? Follow me on other social media platforms. Terry Julian Show at Twitter. Terry Julian Show on Instagram. And again, press subscribe to never miss a video. Ladies and gentlemen, I know this is the kind of content you want. You want deeper. You want more nitty gritty. I'm ready to bring that to you. So make sure you're subscribed. Press like. Leave a comment on this video. Again, share it with your friends and family. It helps my channel grow. Until next time, tomorrow is another trading day. Trade well.